In today's video, we'll explain the concept of Fibonacci levels and how they can be used. To put it simply, Fibonacci levels are used to anticipate price rebounds and to set profit targets. However, it's important to remember that relying solely on Fibonacci levels is not recommended. What are Fibonacci numbers? It comes from the Italian mathematician Leonardo Fibonacci. It starts from 1 and adds up to the next number. Therefore, all the Fibonacci numbers are the result of the last two Fibonacci numbers. Then why is it important and used? It's because this ratio appears throughout various fields, even in the spiral patterns of the universe. It's seen in ancient Roman architecture, the shapes of flowers, and even the proportions of the human body. Not surprisingly, price movements in trading also exhibit this ratio. In Fibonacci numbers, the current numbers ratio is the last one's 1.618 times. Therefore, 1.618 is considered a golden ratio. When observing charts, even in one-way trending markets, there are both upward and downward movements. In a strong bullish market, the goal is to identify the next low price point to capitalize on the upward momentum and avoid missing out on potential gains. But how can we determine the end of a pullback during a bullish momentum? We can approximately expect the end of pullback through using the Fibonacci retracement. On the Fibonacci retracement drawing tool, I only use the 0.618, 0.5, and 0.382 levels only. For using the Fibonacci retracement, you need to find a major level on the chart, such as where the price has reversed recently, like the previous high and the previous low. If you set the same as I did, there are 3 lines in the middle, and those are the main ones that are going to be used. For the bull market, when you are using this strategy, you need to find where the main support is located in these 3 levels. As you can see, the 0.618 level shows support with the end of the pullback and the price starts to go up again. For the bear trend, you can use the reverse way, which is checking the low and high and drawing it to figure out the main resistance. Now it is time to learn the strategy for trading with Fibonacci retracement. The first thing you need to do is identify the current trend. Fibonacci retracement is used for trend-following strategy because the use of the tool is for figuring out the pullback and getting into the trade. Secondly, you need to find the previous high and low. For drawing the levels, you need to find out the right standard of high and low. For easier and clearer identification of the trend, you can add up the moving average indicator. It is simple and easy, but it is made upon the average price movement. It is a way to increase the winning rate of the trades for the beginners. Set the moving average line value to 50. If the candles are above the 50 moving average line, try to get in only long position trades. As mentioned earlier, find the previous high and low to draw the Fibonacci retracement. And when the price shows a pullback, the Fibonacci levels can be a support line. It is not still clear which line will be the one working for the support line, but we can expect the price to rebound from the line. Also, the moving average is also possibly working as a support line. So, spot the price where the levels and the moving average line is close. When you can find it out, set the entry on the level and stop loss on the lower level. The take profit is the previous high, which is where the Fibonacci level is drawn. For the short trade, the moving average line is working as a resistance. Draw the level with the previous low to the previous high and check where the moving average line is near the level. When you can spot the level, set the stop loss on the upper level and take profit for the low that is where the Fibonacci level is drawn. The advantage of this trading strategy is when there are fluctuations in the price to break out the previous high. You can have a few times of profitable trades, and as long as the take profit is on the previous high, it has a higher winning rate because it does not require the expectation of breakout of bull momentum. Hope the trading strategy is helpful for you. See you next time.